Let's take a look at oil prices before we dive into comments from Iraq's oil minister. Brent crude prices fell by 0.4% to $83.03 a barrel by 9:50 GMT, while West Texas Intermediate gained by 0.31%. Iraq made some conflicting comments on Sunday regarding OPEC production cuts, as the country's oil minister initially declared that it wouldn't commit to further cuts. Asked if Iraq would agree to extend the cuts, Oil Minister Hayan Abdul Ghani told reporters, and I quote, "No, I think Iraq has cut enough and will not agree to any further cuts." It wasn't clear if he was referring to an extension or a bigger cut. Iraq's oil minister then walked his comments back, saying, and I quote, "Extending the voluntary reduction on crude oil is subject to agreement between OPEC countries. Iraq is part of OPEC, and it is necessary that we adhere to and agree with any decisions issued by the organization." Joining me to discuss this is Kingsley Okereke, who is Head Securities Dealer in Zcrest Group. Kingsley, such a pleasure to have you here. Good morning to you.
Good morning to you. Thank you for having me.
Most welcome. Now let's begin with what you make of the comments from Iraq's oil minister.
Well, I think Iraq has been through a lot. You know, they've been coming on the back of sanctions being imposed internationally, and that has weakened their economic prosperity in that regard, and that has put it in a very dicey situation. Oil is a significant contributor to its GDP and also to its revenues, and it's seeking to harness more from that, and which is why you see that kind of comment coming from the oil minister, trying to boost revenues going forward. But I think on a larger scale, we've been having issues with OPEC. A lot of members have been a bit disgruntled because of these cuts, right? And you even look at the back of that, you will see that even the UAE at some point has blamed OPEC for being responsible for its weak economic performance, looking at GDP figures, because of this sustained cuts and also maintaining of the quota in that regard. So OPEC has to try to walk a fine line to balance warring factions and interests to keep the group together, because if you walk back just a couple of months back, you will see that Angola pulled out of OPEC for the same reason, because of this limiting OPEC quotas, and also his issues that he's having in that regard with economic performances as well.
So there's a need for harmonization, you say that.
Pretty much.
Taking all this into account, what does this say to us about unity within OPEC itself?
Well, unity, I think, as I said, the OPEC leaders really have a lot on their plate to deal with. And I think it is part of those back channel moves that I've seen the Iranian minister walk back his comments that you've seen that was just aired on Sunday. So I expect more of those kind of back channel moves and to try to keep the alliances strong, because even the Saudis as well, they also need very good revenues coming from oil. Their capacity is 12 million barrels, but they are limited that to 9, and at some point they were voluntarily cutting an extra $1 million in supplies to the market. So everybody needs money. Russia itself, that is also part of that OPEC plus, also needs revenues to try to bolster its war that is waging on Ukraine. So you see that there's that drive to boost their economic importance and strengthen economic competitiveness in that regard. So, but I believe that, as I said, OPEC leaders will be trying to see how they can rally support round within the members and balance the act. But I believe that they would be able to achieve that in no distant time.
All right. Quite a few moving parts there, but all for the best is what we're expecting. Now, the next meeting of OPEC ministers is June 1st. This is highly anticipated. Do you expect that production cuts will be maintained at this point?
Yes, I do believe they will maintain, but further cuts will be very tricky. But maintain is what I think is the likely course of things, given all these moving parts. We don't want to see the cartel having to deal with more member exits on their side and the collapse of this OPEC plus alliance in that regard. So, yes.
Okay, now let's look at what to watch this week, with particular focus on Jerome Powell in Amsterdam on Tuesday. Can you draw a link between U.S. monetary policy and how it impacts, has an effect on fixed income and money market rates in emerging economies such as Nigeria?
Well, the impact is just straightforward. Pretty much most market watchers and analysts were expecting the Fed to cut rates, but you've seen that the data, especially looking at inflation, has not provided those kind of favorable conditions for that to occur. We've had that U.S. inflation is pretty much elevated at 3.5%, which is not what the Fed chair, Jeremy Powell, would have expected to see at this point, and that has not allowed them to cut. The story is a little bit different on the ECB side, where you see inflation at 2.4%, closer to their 2% target. So market watchers expect the ECB to cut in their next meeting. So going back, for me, I think that the Fed will be data dependent. And with his meeting, I think he's still going to re-echo sentiments showing that they are still going to wait to see the data, how the data pans out. But he's going to also knock off the initial commentary that was suggesting for some type of rate hike, because even a few Fed officials have opined that they don't believe that monetary policy is sufficiently restrictive to achieve their mandate, So, and we've also beginning to see weakness in GDP numbers. GDP is now at 1.6, which was lower than an estimate of 2.4. So, and that is pretty much concerning because the Fed has a dual mandate. So if the Fed is not looking to cut rates anytime soon, higher rates for longer would impact emerging markets, and we continue to see yields at sufficiently elevated levels for these countries, and debt burden and debt concerns become still a sticky issue that fiscal and monetary authorities need to work in these emerging economies.
So quite a few factors are going to need to play a role there. And of course, we have to keep our eyes peeled for and see how things go on Tuesday, which is just tomorrow. So, of course, we're expecting U.S. producer price index on Tuesday as well as consumer price index on Wednesday. Now, if both come in hotter than expected, how does the Federal Reserve react? And how does that impact us in Africa?
Well, if it comes in hotter, definitely I expect them to maintain interest rates at current levels. What we have seen is that consensus view is that interest rate cuts are going to come in somewhere in and around November. What one would have hoped is that that would not happen because that would be close to or at the very point of the general elections for the U.S. And the Fed doesn't want to seem to be a determinant or a key player in the determinant of who wins that two-horse race between the incumbent President Joe Biden and his closest challenger, which is Donald Trump. But that is going to be the case for now. So what you would likely see is an ECB cut in June, and we also expect to see more cuts from the ECB, given that they are close to their inflation target. For BOE, which is the Bank of England, they also would like to cut rates. I think they're also in a better position. It's just that market is still watching to see whether that's going to happen in the next meeting or the meeting after that. So for African economies, we believe that interest payments on and servicing of their debts in dollar terms will still be elevated. And for some of them that were hoping to come into the market on the back of a Fed rate cut, I think that timeline will have to be pushed back a little more, or they have to do a reassessment to know whether, they would rather want to come in at this point, given these higher rates, or they will have to, shelve their plans to somewhere down the line when financial conditions are a little bit looser.
What do you suppose will happen, though? I'm talking with regards to both coming in hotter than expected. Do you expect that we will see that eventuality? Yeah,
well, what we see in the market is that we expect CPI to come in at 3.6, which is just a slight notch above where it printed at in the last report. And that is confidently where we see market printing at. What has made inflation sticky is gasoline prices and shelter cost, also services as well. So we begin to see that runoff, and deceleration in inflationary pressures should start to pass through the economy, and that is why projections are just a slight uptick in that regard. So market watchers are not really expecting a hotter inflation, but if a hotter inflation comes up, what it means is that we would likely see U.S. Treasuries go up. You also see negative performance on the various Wall Street indexes and all that. So But for African economies, as I said, you also see some weakness also in Eurobond space, especially for sub-Saharan Eurobonds.
All right, so it's still a healthy outlook either way, depending on how one approaches it, except for Africa.
Well, hopefully,
except for Africa.
We are hopeful. We are hopeful that CPI figures begin to abate, and that would because Nigeria is also looking to tap into the international Eurobond market. So we are hopeful that that can come in because we need healthy dollar flows to be able to help stabilize the currency.
Yeah, that's certainly quite necessary. But let's touch on international trade now. What do you make of the U.S. displacing China to become Germany's top trading partner?
Well, I believe that it's a couple of factors that are driving that. One, you will look and see that China in itself is getting a little bit more sophisticated and producing more complex goods locally and reducing their reliance on German imports to support their economy in that regard. On the flip side, too, Germany as well is also going that same route. And it has a bit of a political tone to it because Germany is not so much in agreement with some of China's policies that it has taken and its stance. And with that, they have started to, reduce their dependence on China. Also, you look at the economic front, you see that China has not fared well. China has been dealing with, a very weak property market, pretty much in comatose. Although recently we got some news that Country Garden has paid some of his interest on the bonds that it has that were maturing, and there are some that is also looking to pay interest as well on those ones. So that's good news, and we've also seen a bit of good news from China with their imports and exports improving as well. So demand side is beginning to improve domestically and also from the global side of things. So and U.S. has fared better, looking at economic prosperity there. We've seen the economy has been resilient. I just opined that, GDP came out at 1.6. So I think Germany is just tilting more to their transatlantic partners and strengthening ties in that regard and reducing reliance on China, just to also show posturing and how they disagree with some of their policies. Besides, the gap is not so wide. It's not like China cannot change and, see how they can, strengthen their ties with Germany in that regard. But another thing you need to watch out is that along the line, the November elections could actually play a key figure because if Donald Trump comes into play with his America Great policy, Make America Great policy, that could also change the dynamism of things relations between Germany and the US, and that could affect how that data.
I'm glad you mentioned that because I was about to ask you what are some of the immediate and short-term effects of this for US-German relations?
Immediate effect is that for now that is being strengthened, for their relations, and I expect that more closeness and bilateral trade kind of relationship to foster, between them for America. But as I said, going into the elections, if the major contender wins, that could actually change things for their relationship.
Yes, we have to wait and see how that goes because it's a very important point that could completely tip the scales there. But let's finally round up with South Korea, which is planning a support package of $7 billion for its chip industry. Let's talk about what you make of the chip race we've seen in the developed world, I beg your pardon, so far.
Yes, everybody wants, to have a significant stake in the evolving digital economy. And we've seen that South Korea is a significant player. I think after Taiwan, they are next. And all what that South Korea is trying to do is that, they are trying to ensure that their leadership position is well cemented and strengthened, right? They have significant players like Samsung that is there, and they want to ensure that they continually pump in good investments to ensure that that space evolves and their significant market share is strengthened further. For every other player is just trying to see how they can eat deep into that market share and displace some players in that regard. We've seen that artificial intelligence has been, at the forefront which has spurred this significant move. But with Korea, again, you also look at, economic competitiveness. You also look at supply chain. They want to be more self-reliant because it's also a national security issue as well. Some of these countries also have that at the back of their mind, because you would not want, an international player to be a major stakeholder in your telecom sector, in your defense apparatus as well. So it's also a national security issue for some of these global players. So primarily for South Korea, global demand, supply chain issues and reliance in that part, technological advancement and being a global leadership in that technology space, and also contribution to its GDP as well. I think it accounts for about 15% of its GDP. So, and is a major employer of labor for them. So that is pretty much one that they are looking at constructively and ensuring that their dominance there is solidified.
Right, very interesting week so far, and it's only Monday, so we have quite a bit to look forward to. Absolutely. Kingsley, I want to thank you so much for joining me. Global Business Report today. Lots to talk about as the week progresses. Many thanks for joining us.
Thank you for having us.